Good morning, it's me, Kenny Polcari. Today is Wednesday, May 29, 2024, and here are the things that you need to know to get your day started. So, what happened yesterday? Well, Nvidia finally did it. It took the Nasdaq up and through 17,000, creating yet another new index record. Elan Musk announces that he's using the Nvidia H100 chip in his new XAI startup, and everything tech got taken higher while the broader market, though, struggled, right, and moved lower. The bond auction for the 2s and the 5s was not well received, and guess what? We got a 7-year treasury note auction today. The PCE report remains in focus on Friday, and what do we have for dinner tonight? We're gonna have the fresh fettuccine with shrimp and spring veggies. Delicious. Okay. Well, it finally happened, although I was a day late and a dollar short because I thought it was going to happen last week. But yesterday, the Nasdaq kissed and then pierced 17,000, and you can thank Nvidia again as traders and investors and algos took it up 7.1% or $76 a share to end the day at $1,139. This, though, after testing a high of $1,148. What was yesterday's headline? Well, Elan Musk announced that his AI startup, XAI, which just raised $6 billion and now has a $24 billion valuation, is going to be using Nvidia's H100 GPU chip. Cathie would think ARK Investments putting $60 million, representing about a 2% position into that new startup. And that's in addition to her 4% position in ChatGPT and her 5% position in Anthropic. Wood is telling us that the AI foundation model should be worth multiple of trillions of dollars by 2030, just 6 years away. And this dragged anything tech higher, right? All while the broader market appeared to struggle. By 4 p.m., the Dow had given up 216 points, or 0.6. The S&P was up 1 small point. The Russell lost 2 points. The transports gave up 87 points, while the equal-weighted S&P lost 20 points. And since there was not any real economic data, you have to ask why. What happened? What derailed the latest rally? Okay, hold your hats, because you know what the answer is. We've discussed this before. Stocks, technology, and bonds both came under pressure because yesterday's $70 billion 5-year treasury note sale and yesterday's $69 billion 2-year treasury note sale went mediocre at best. And today, we're going to brace ourselves for the 7-year note sale, right? Remember, mediocre is not good. As a result of the latest auction, the 2-year yield ended the day at yielding 4.97%. That was up from 4.94. The 5-year is now yielding 4.55%, up from 4.54. And the 10-year rose 8 basis points to end the day yielding 4.54%. Now, what that means is that Janet, right, Treasury Second Yellen, brings new supply to the markets. Buyers have to assess the risk while the Treasury has to assess demand. And as discussed ad nauseum, all that means is that as she brings more supply to the markets, then buyers are going to bid lower, causing yields to go up. And that's exactly what we saw yesterday. And higher yields will pose a problem for stocks at some point. We've already seen what happens to stocks when the 10-year kissed 5% in October, right? Think about that. S&P was down 9%. The Nasdaq took a 12% hit. And it's not that there aren't any buyers of our debt. There are plenty of buyers of the debt, but they're just becoming more discerning. They're not going to stand in front of a moving train. They recognize that Janet is going to need to bring more supply to the market, and more supply just means to pay off this outstanding debt that we have, right? 34.5 trillion and counting. But more supply just means that prices will go lower and yields will go higher. And all that means is we should expect stocks to reprice the risk based on this factor. This should come as no surprise to anyone because we've discussed this. And while I'm not sounding the alarm bells, I am reiterating that you need the plan. That's all. You just have to have a plan on how to deal with this. Now, all of this is happening ahead of Friday's PCE report, which is the Fed's favorite inflation gauge. You know that. And while all the chatter from the Fed is and has been higher for longer, there are still some out there that continue to expect the Fed to cut multiple times before year end. And they're hoping that Friday's report is going to be the catalyst for that move. Swaps, though, swap contract traders are only betting on one rate cut this year, coming in December. But it's a different group of asset managers that are betting on multiple rate cuts. never mind that Neely Kashkari, Minneapolis' Fed president, along with other Fed presidents, reminded us that everything is on the table, including rate hikes. So I guess maybe they could raise rates in June and then they could cut in July, September, November, and December. This way everybody gets what they want, and that would be multiple rate cuts. I think it's ridiculous, but whatever. Now, something that's not being discussed as much is the fact that starting today, the Fed is going to launch a series of buybacks for seasoned, hard-to-trade debt, hoping to take that debt off the market, freeing up those buyers who are trying to create some new demand for the current supply she's going to bring. All while beginning to taper or slow their pace of quantitative tightening, right? Which should ease rates without actually cutting them. Gabish? It's all very orchestrated. The Fed can ease policy without actually cutting rates. It's funny how that all works, but that's something you have to be aware of that could be happening. Now, understand how they can and will position Friday's PCE report. Consensus estimates are calling for a 0.3% increase in the top line and core month-over-month rates, right? The same. But economists are expecting the core PCE to rise by only 0.2 for April. And if that's true, then this is what they're going to say, that it's the smallest advance this year. Now, you see how they turn that into a positive? It's a negative, but they turn it into a positive. And boom, if that's the case, then they're going to have to cut rates, right? In any event, it is what it is, and we won't know the answer until we do. For now, I'm still in the no-cut camp for 2024. Now, U.S. futures this morning are under pressure. Dow futures down over 200 points. S&P's down 35. Nasdaq down 130. The Russell's down 22. The 7-year Treasury auction is later today. And after yesterday's tepid response for the 2s and the 5s, the sense is that we're going to need to brace ourselves for further weakness today. Now, Julius Baer equity strategist Leo Pellandini tells us, and I quote, "The higher for longer bond yields risk is biting into equity valuations, and short-term pressure seems to be a given. Nevertheless, though, with inflation expectations moderating and interest rate cuts coming soon, we think markets continue to climb higher." Okay, Leo, define soon. Do you really think the U.S. data demands a rate cut anytime in the next 6 months, considering that inflation is already beginning to turn its head up again? Or is soon being defined as sometime next year by you? I mean, you have to define it, because it really doesn't make sense. Now, the only thing I see that could change my mind is if we start to see downside surprises in the coming inflation reads. And after the hotter PPI read 2 weeks ago, I just don't see how you're going to see that happening at least next month. But if that happens, then watch out, because that might suggest something very different. That the economy is weaker than suggested, and that bad news is really bad news. So cutting rates would be necessary to try to prevent a hard landing, a move that would most likely fail because the Fed would be being reactive and not proactive. Unless, of course, they slash and burn rates, taking them back to subnormal levels. Oh boy, it is a tangled web we weave. Now, eco data today includes mortgage apps, the Richmond Fed Manufacturing Survey, the Dallas Fed Services Survey, and the Fed's Beige Book. And remember, we are a 75% services economy, so the Dallas number will be key. Oil, which had been trading under $80 a barrel for the month of May, suddenly pierced $80 yesterday. Remember, I said that many are now expecting oil to retake that $80 level as expectations of the ongoing production cuts out of Saudi Arabia and the beginning of the summer driving season seen here in the United States. And that is exactly what happened yesterday. Analysts announced that they expect OPEC Plus to continue the ongoing production cuts on Sunday when they announce on June 2nd, just as demand is surging here for the summer driving season in the U.S. Now, this morning oil is trading at $80.50, just a hair below trendline resistance at $80.85, where I think it will find some short-term pressure before pushing up and higher throughout the summer. Gold continues to churn and bounce off the trendline support at $20.50 as gold traders await the latest inflation data. Now, we've seen gold traders take some profits lately because gold traded up as high as $24.50. Now it's trading at $23.50. So they've been taking some profits over the last couple of weeks. Unsure of what the data is going to show. Rate hikes are going to put pressure on gold and other precious metals, so we just wait, right? But current rates held here, even if they're for longer, I think are already priced in. So therefore, I think we're going to find support at $23.50 in gold. I think we remain in the 2350, 2450 range. Remember the VIX? Remember how it suggested that there was no fear? Remember how I said all we needed was just one catalyst to ignite the fire? Well, yesterday we got that catalyst, the bond market, and that sent the VIX surging by 4.5%. And this morning it's up another 1.1% at $14. If the 7-year auction is poorly received, then watch as the VIX continues to push higher, right? And that will put pressure on stocks. And if the PCE report is not what they expect, well, you know what happens then? European markets are all lower this morning. France and Italy both down about 9/10. This after a tough day on Tuesday, as investors now begin to focus on rising global bond yields, all while the ECB appears to suggest that a rate cut is on its way next week. But any further easing will be slow and gradual, they tell us. That one cut does not mean another cut is imminent. The S&P closed at 5306, just up 1 point yesterday, which was a win, right? Considering that the Dow, the Russell, the Transports, and equal weight all ended the day lower. This morning, U.S. futures are down. Like I said yesterday, I think we're a bit toppy here, so I continue to look for a pullback, right? Not a crash, just a nice, healthy pullback to the short-term trend line support, maybe at 51.76, or even intermediate term at 50.70. Neither of which is an alarm bell, by the way, because either move is well within the normal trading band. The alarm bell would be if we test and fail at the long-term trend line, which is 47.60. That would be about a 10% move, something I do not expect to see. Call me to discuss, because you know me, I'm always happy to do that. Love talking about the market. Okay. So here's the deal. What do we have for dinner tonight? So we made this over the weekend. My wife made this over the weekend. It's really, really delicious. We went out to Doris's. We bought fresh fettuccine. I bought cleaned in the vein shrimp, large shrimp, and a bunch of spring vegetables, right? It's simple to make. It's very good. It's going to become a fan favorite. So for this, we needed the fresh fettuccine. I needed the cherry tomato sliced in half, plenty of sliced garlic, broccolini and baby asparagus spears sliced into bite-sized pieces. We needed large shrimps, which I got cleaned into vein, olive oil, butter, a little bit of chicken stock, salt and pepper, and fresh grated Parmesan cheese, as always. Begin by bringing a pot of salted water to a rolling boil and put it on the back burner so that it's ready when you need it. In a large saute pan, heat up about a quarter stick of butter and a splash of olive oil. Add the garlic and the seasoned shrimp, right, that you just seasoned with salt and pepper. You could put a little bit of paprika on it if you want. Now, cook the shrimp until they're pink on one side, then flip them over, cook on the other side. When they're nice and pink, take them off, remove them, put them in a bowl, but cover them to keep them nice and warm, because you're going to use them in a minute. Now, in that same saute pan, add a little bit more olive oil, add some more garlic. Now add the sliced cherry tomatoes, saute those for 3 to 5 minutes. Now add in the sliced up broccolini and asparagus, add a cup of chicken broth, and then allow the chicken broth to blend, and then allow it to steam off as you're sauteing the vegetables in that mix. Now add the pasta to the pan in the back. Let it cook. It's going to cook very quickly. It's going to cook in about 3 minutes. When the pasta's done, add it to the saute pan with the veggies. Add 1 ladle of the pasta water. Add a handful of cheese. Mix it really well. Serve it in bowls and top it with 3 or 4 of the cooked shrimp. Put that right on top. Have more cheese on your table for your guests. It is simple. It is delicious. You'll enjoy it. You get everything in one meal. You get fish, you get veggies, and you get pasta. What could be better than that? In any event, until tomorrow, take good care.